Hello everyone, welcome back to my channel Finance Know How. In this video, we are going to understand what is MAT and how to calculate book profit and everything. MAT is applicable to the companies, only to the companies, which could be any type of company, foreign company, government company, or non-government company. Okay. How to calculate tax liability under MAT? So you can calculate tax as per income tax law and 15% on book profit as per MAT law or MAT rules. Okay. Whichever is higher, you have to pay tax that. Okay. Now below I also shown you like the rates which are applicable to foreign and domestic companies, surcharge rates, SAS, everything. Okay, which is just for reference purpose. You can read this. I can share these notes in the below. Now, following are the exemption under MAT, like lower MAT rate, which is 9% for units located in an IFSC. So you are deriving income in foreign exchange. You can use 9% MAT rate for these units. Okay, and MAT is not applicable to the foreign companies, sorry, not foreign companies, life insurance companies and companies opting for following tax regime under section 115 PAA and 115 BAB. Okay, there are also some foreign companies which are not applicable to pay MAT. So what are those? First is if they are resident of any DTAA country with no PE in India, and if it's a foreign company but resident in a non-DTAA country not requiring registration under Indian company law. Now, foreign companies with income taxable under special rates. Foreign companies with income taxable under special rates like 44B, 44BBA, they are also not applicable to pay MAT. Okay. In the next part, we are going to understand how to calculate or compute the book profit. So, to calculate the book profit, you have to make some additions and some deletions. Okay. So, what are those additions and deletions? So, starting point is profit as per statement of profit and loss as per Companies Act. Okay. You have to make following additions in this calculations. First of all, you can only add if you have debited in PNL. If you are not debited in PNL, you can't add back. Second catch is point number 10 and 14 below is exception. If you are not debited in PNL, still you have to add back. Okay. So note these things before going ahead. So point number 1 is income tax paid and provision include interest on IT, DDT, surcharge and education cess. Second is dividend paid and proposed. Third is transfer to any reserve you have to add back. Losses of any subsidiary company you have to add back. Provision for uncertain contingent liability you have to add back. Expenses for earning tax exempt income under the following sections you have to add back. Depreciation debited to P&L you have to add back total depreciation. Provision for diminution in assets value you have to add back. Deferred tax you have to add back. Balance in revaluation reserve on retirement disposal of assets if not credited to P&L still you have to add back. Okay. Expenses related to share in income of AOP and BOI. Expenses linked to foreign companies income, which is capital gain on securities, dividend interest, royalty fees, extract. Notional loss on exchange of SPV shares with business trust units. Okay, you have to add back. The point number 14, which is we are waiting, but still carrying in change in carrying amount of units and loss on transfer of units, you have to add back. 14 number is actual gain on transfer of business trust unit, which is sales price minus cost of SPV shares. If you have not debited in P&L, still you have to add back. Okay, expenditure related to royalty income, you have to add back. So now we are talking about deductions. Deductions are like withdrawal from reserves. If reserve was created by a P&L, you have to deduct it again. Income exempted under section 1112, you have to deduct. Deferred tax, you have to deduct. Depreciation excluding revaluation of assets, you have to deduct. Profit of industrial companies, you have to deduct. Okay. Next point is transfer from revaluation reserve limited to depreciation on revalued assets. So you have to deduct. Brought forward losses and unabsorbed depreciation for brought forward losses and unabsorbed depreciation for companies under corporate insolvency resolution. Okay, under IBC 2016, companies where tribunal suspended board of directors and appointed new directors, where subsidiary equal to more than 50% equity had in parent company. Okay, so this is the point. Point H is brought forward losses and unabsorbed depreciation. Okay, whichever is lower, you have to deduct. Point I, share of income in AOP, BOI already taxable in following hands, you have to deduct. Income of foreign companies from capital gain on securities or interest, dividend, royalty, FTS if tax rate is less than 15% of MAT rate. Okay, notional gains from exchange of SPV shares with business trust unit, change in carrying amount of unit, transfer of unit. Okay, and point L is actual loss on transfer of business trust unit, which is SPV of units minus cost of SPV share. Point M is royalty income taxable under 115 PF, which is 10%. MAT is not applicable there. So this is all the adjustments of like book profit calculation. There are some keynotes which we need to understand. One is book profit calculation based on the Companies Act. This for most companies and for electric banking and insurance companies use profit as per respective act. Okay, and provision excluded from additions. Following provisions. So these provisions are excluded from additions, which are gratuity, leave salary, warranty provision if based on actual and scientific valuation. So depreciation treatment under point above, which is in addition point number 7, and deduction point number D must be calculated as per Companies Act, not as per income tax. And brought forward losses and unabsorbed depreciation recognized only as per Companies Act. Okay. Now part 2. What is the part 2 is? Like there are some additional adjustments which we can understand as per India's Companies Act compliant companies. Okay. So after computing book profit above, okay. So if you are a company where Ind AS is applicable, you also need to do the following adjustment, or you have to add following into the book profit. Like this is very complicated sometimes to understand for many students, but we can try to understand that. First point, if items are credited to other comprehensive income, not reclassified to profit and loss, that you have to add back. Second is gain from fair value change in equity instruments through OCI and revaluation surplus on assets retirement and disposal transfer. You have to add back. No cash assets distribution cost. Okay. Sorry, my bad. It is third one is non-cash assets distribution cost, which is like demerger under India 10 Appendix A. You have to add back. Okay. And fourth is 1 by 5th of transition amount. Explain below. So I can also explain you below in that. Before understanding that, we can understand what we have to deduct from book profit. Item A, if anything is debited to OCI, not reclassified to P&L. Losses from fair value changes or revaluation surplus on assets disposal. Credits from non-cash assets and 1 by 5th of transition amount that you have to deduct from book profit. Okay. Now final output. Final output is book profit for India's compliance equal to part 1 of the book profit and above adjustments. This is the book profit for the companies who have Ind AS is applicable. Okay. There are some points which you no need to do any adjustments, which are exclusions from the adjustments, like revaluation risk surplus, fair value gain and losses on equity instruments. Like MAT applies only when assets and investments are retired, disposed, and transferred. Okay. So there is a demerger treatment for the resulting company in a demerger. If assets liabilities are recorded at value different from demerged company books, ignore such value changes when computing book profit. Okay. Purpose is preventing artificial inflation and reduction of book profit due to revaluation during merger. So above we are hearing what is transition amount. So transition amount is adjustment in other equity excluding capital reserve and security premium on the convergence date but exclude. Now we are understanding what is convergence date. We can also understand this going ahead. We have to exclude following 6 items. OCI item later reclassified to P&L, revaluation surplus, fair value gain and losses on equity instruments, PPE intangible assets recorded at fair value, investment in subsidiary JV associated fair value, cumulative translations difference of foreign operations. So impact on book profit when assets and investments or foreign operations are retired, disposed, transferred. Adjust book profit by the full amount of previously excluded item. Okay. Now convergence date is first day of the first Ind AS reporting period, and year of convergence is previous year containing the convergence date. Okay. Now we understand what is MAT credit provisions. So key rules is carry forward and set off. MAT credit can be carry forward for 15 assessment years, allowed only in the years where normal tax is more than MAT. Okay. How to calculate MAT credit equal to 15% of book profit as per MAT minus normal tax MAT credit equal to 15% of book profit minus normal tax. Okay. Now what is the utilization limit? Only to the extent that normal tax exceed MAT in the given year. Restriction क्या है इसमें? Conversion to LLP. Unused MAT credit can't be transferred to the successor LLP. Okay. The amount of MAT credit will be reduced by FTC allowed against MAT minus FTC allowed against normal tax. Okay. Now here are some important notes. Compliance requirement. Companies liable for MAT must pay advance tax and interest under section 234A, P and C. Now legal, एक केस है अपोलो टायर का. You cannot recompute PNL format. Only adjustment specific in under section 115 JB are permissible. Okay. He can't recompute PL format. Okay. I have provided an example of MAT credit utilizations. You can go through with that. It's very simple and easy. If you have any question, you can ask me in the comment. So here we are understanding amendment as per Finance Act 2021. APA and secondary adjustment impact. If current year book profit includes past year income due to following reasons like advance pricing agreement, secondary adjustments, SSC may apply for recomputation of past year book profit and tax. What are the conditions? There is a time limit, like rectification under section 1154 must be within 4 years from the financial year end in which application is made. MAT credit applicable only if unutilized MAT credit exists from earlier year. Okay. So above provisions are applicable to only AY 2021 and earlier. Refunds arising from these provisions do not carry interest for SSC. And this is an optional adjustments. Company may choose to apply for adjustment under this provision. Okay. So this is all for MAT credit.